you're considering setting up a real estate private equity fund or a mergers and acquisitions private equity fund, and you're hearing the term general partner and limited partner, but sometimes there's this idea called the investment manager, which is actually a third company. What really is that, and how many companies does somebody need to make when they're creating their real estate or mergers and acquisitions private equity fund? You basically have to look at it like this. Many times when people set up a real estate private equity fund to acquire many real estate deals at once, or a mergers and acquisitions private equity fund so that they can acquire a bunch of companies and put it into a private equity fund, what a lot of people notice is you have different ways that you can set it up. And the most common way is when you have a general partner and limited partner. So what really is a general partner and what really is a limited partner for those who don't know? So the general partner that's really the company that is owned by the owners of the private equity fund. And they're responsible for doing a lot of the work, finding the deals, underwriting the deals, acquiring the deals, and then they're really the ones who are raising capital and selling to investors. And then you have another company called the limited partnership, and that's what is being sold to investors is units of that limited partnership. And then those units are the thing, that's really what is being acquired. So those units really own the assets that the general partners want to buy. Let's say you want to buy one of the buildings behind me. What you do, you create a general partnership company, which could be an LLC, it could be a corporation, it could be a corporation, an incorporation in Canada. The same thing applies in any Commonwealth country, by the way. So you create this entity like an LLC or a company, right? And you create another partnership called a limited partnership. And the limited partnership that's really the place where people invest. People buy units of that limited partnership to become investors. When people buy like all the units, let's say there's 1,000 units priced at $10,000 each of limited partnership, then they're buying that sum total of all of that's how much they're investing into the limited partnership. And then the general partner gets a reward, gets their commission, gets their percentage of all of the money that's invested, and then they get a share in the profits that they make for the investors in that limited partnership. But sometimes people get confused when they see something called the investment manager. And the investment manager, all it is a company that is underneath the general partner. And sometimes it's a third company because there's a general partnership, there's a limited partnership, and then there's the investment manager, which is also another, it could be an LLC, it could be a corporation, basically it's a company. And so what really is that? This entity called the investment manager. And the investment manager is the third company that people can choose to delegate some of the investment management to that investment manager. So the general partnership, maybe they'll be in charge of just the high level vision of the company. And then you can have another company called the investment manager, where you have like a team of people that are underwriting the deals, that are doing analysis on the deals, and then that are going out in the streets seeking and looking for those deals. So all in all, those are the two different approaches. You can have two companies that you create for your real estate or mergers and acquisitions private equity fund, or you can have three companies. If you do the two company setup, you have the general partnership and the limited partnership. If you have the three companies, you have the general partnership, the limited partnership, and the investment manager. And generally, if you're somebody you're wondering what all this is, you're probably best off just doing the two company setup, because less complexity, simpler. And you're probably not looking to build a giant team, and you don't have a giant team of investment managers who are looking to scale the private equity fund for your real estate or mergers and acquisitions deals in the next few years. And you can always consider adding one on later. And many of the people that we work with at Raises.com that want to move forward with speed, they just have the two company setup. And there are even some sophisticated investors that have raised over 600 million, that they just use a simple two company setup. So sometimes people have the three company setup when they really want to impress people, or they're working with investors and they find that they want to really just show and quote unquote show off or flex, or basically they want to show face that they're able to structure their company just like the institutions do, because it's a very high status. The three company setup is a more high status way of doing it, and it can just show that you're prepared and you know what you're doing. So the only problem is that, I guess it's a solution, is like sometimes there's some tax benefits to the three company setup, because the amounts that the general partnership would pay on the tax for the profits that they make from making money for investors. Sometimes people use the investment manager as a way to lower those profits and then to save some money on tax. And obviously this is something where a CPA or a tax advisor can talk about the details in whatever state, province, country, or jurisdiction makes sense. But in general, people sometimes use the 3-company setup to save on tax. But the downside is it does add extra complexity. And if you don't have multiple people, that you're not looking to scale to multiple employees or something like that, then it may not make sense. But the way to know what's right for you is to, number one, look at your tax situation. Try to see if you can, when you make profit as a general partner, you can probably look at ways to lower some tax, talk to a tax advisor. Number two, look at what people in your area are doing, because sometimes for a private equity fund, just for one real estate syndication, sometimes people do a 3-company agreement if they want to show face that they're very sophisticated. But sometimes you see people who raise hundreds of millions just do the 2-company agreement, maybe for simplicity's sake. And so everybody's situation is different, but there's not one right answer, but just look at the tax savings that you could potentially make based on your situation, to make sure that you look at what other people in your area are doing and deals that are recently funded. And so with this, thank you for watching this video. And if you need help, just head to